Today we're talking all about the home equity conversion mortgage, so HECM for short. Now it's very similar, but not exact, to a reverse mortgage. Now don't hang up the phone, don't turn off the channel. The HECM, in my opinion, is a much better product than a reverse mortgage. It's very similar, and reverse mortgages are very good for those that need that product. It may not be great for all, but nothing is really great for all, except maybe some good rest, smiling, some fresh air. All right, that's another video, but you know, the body does need sunlight. But that point aside, the HECM, the home equity, basically what you're doing is you're taking the equity of your home and you're giving yourself an income or a monthly stipend, let's say. You're giving yourself money on a strategic basis over time. So a little bit of a draw each time. So it's not like refinancing the home, taking all the cash at once, which you certainly could do if you can budget and if you're able to do that. And if you're able to be, conservative with it. You can take all the money at once. The rates are always much better than doing that, saying let's pull from a line of credit or a home equity loan. The HECM or the reverse mortgage, similar product, are much more rate conscious and much more financially dependable. Now, when you're as you live and grow in time, the appraised value of your home is still going to go up. I mean, the value of your home is going to go up. How much? I mean, I can guarantee you 2% a year, probably more like 4, 5, 6-ish%. In the last few years, the market's been nuts, and some places are up like 25%, 50% in some cases. But historically speaking, so you're able to pull more equity. You can refinance that. The program allows you to take the money all at once. Well, you can refi and cash out, but it's better than a cash out refi because you can capture more equity of your home, and that's the key to this. It's a great way to let's say even live for a little while, and then maybe you're going to be retiring elsewhere, or you want to stay that way for the next 5 years, maybe while your spouse is continually working. You can have that extra income coming in where you're not losing the income that you're used to. You do have to be careful, however, of course, not to take too much all at once, or at least be very budget conscious. Now, is that a word? Budget conscious. All right, so if you didn't want to do this at all and you're like, holy cow, what am I supposed to do? So we got a lot of buyers now, and in this age group or say that has a lot of equity in their house, whether they're older or not. Usually most of them are older because they've been in their home and have paid their home down. So there are other ways around it. You can get an ARM, an adjustable rate mortgage. You can get a buy down. We don't have to be, they say marry the payment, not the rate, right? It's easy to say, well, don't worry about the payment or get an adjustable. In 5 years, it could adjust higher. Absolutely, yes, it could adjust higher. Not a doubt. However, it probably won't. Easy for me to say, right? Well, at any point through those 5 years of this adjustable rate, at any point you wanted to lock in your rate, you could. Call your current lender. Ask them, can I transfer the rate to another property? Some of them are allowing you, very few, but some of them want the business and they're going to allow you to do it, and they have the power to do so. Get an ARM, get a rate buy down, get on the phone with your current company. Also, get a grip. Now, it's not as bad as you think. It's not as hard as you think, but give us a call. We'd be happy to. We'd be happy to put you in touch with our preferred lenders, and they could talk to you about it with, without any obligation or any cost to you, of course. So if you have or need anything from us, we're glad to help. I'm happy to do it, even if it's not real estate related.